since I kind of discovered that everything code thesis about liquidity being the dominant driver, I realized there's one macro driver that drives everything. And then on top of it is the adoption of technology, whether it's crypto or tech. Those are the two mega trends. Nothing else outperforms the debasement of currency, which is 8% a year plus 3% inflation. So 11% a year is what you need to do to break even on your savings. And so you've only got two assets to do it, technology and crypto. And when I divide the NASDAQ by Bitcoin, it's down 99.97% since 2012. On every time horizon, it's underperformed. But they're driven by the same factor.
Raoul Pal emphasizes that liquidity is the primary macro driver of markets, shaping everything from traditional assets to cryptocurrencies. He highlights two dominant trends: liquidity cycles and the exponential adoption of technology. Pal believes that breaking even on savings requires outperforming currency debasement and inflation, which total about 11% annually. Only technology and crypto, particularly Bitcoin and Ethereum, consistently meet this benchmark, with Bitcoin vastly outperforming the NASDAQ since 2012. Pal discusses the exponential age, where technological advancements like AI, crypto, and clean energy accelerate rapidly. He sees exponential assets, those driven by network effects, scarcity, and innovation, as the future, offering superior returns compared to traditional investments. Liquidity plays a pivotal role, and navigating its cycles is key to capitalizing on these opportunities. Pal advises against emotional investing, leveraging, or FOMO, and stresses the importance of secure token storage and a long-term mindset. Lastly, Pal and other experts like Arthur Hayes project significant growth for Bitcoin, citing its fixed supply and growing network effects amid expanding global liquidity. While Pal focuses on exponential adoption across assets, Hayes anticipates Bitcoin leading the charge before altcoins gain momentum. Both agree that the evolving macro landscape positions crypto for unprecedented growth in the years ahead.
To explain the exponential age, it's this extreme exponential adoption of these technologies, whether it's AI, whether it's crypto, whether it's EV, whether it's robotics, whether it's space, all of these things. And they are all on a log return. So they're exponential if you look at price charts. So that is the game we're playing. Those exponential assets, if you think of Amazon stock, back in the early 2000s, it fell 97%, it went up 600%, it fell 50%, they're volatile. So they're volatile assets, but if you can hold on to them, the returns are truly extraordinary. This is why Jeff Bezos is the richest man in the world, or close to it. It's all the same thing. So that is the mega trend. That's the exponential age. Within it, you have the business cycle and the liquidity cycle that drives this. So what you find is you need to understand where you are in that cycle. That cycle is driven by liquidity flows, let's say. And recently we had liquidity tightening from a strong dollar and higher rates in Q4 2024. That has a 12-week lead into assets. So assets fell because liquidity had tightened then. Liquidity has been doing the opposite now. It's been easing massively. And so price should follow. But the volatility is big, right? People don't realize is, you're used to a 10% being a correction in the S&P and anything above 20% is a bear market. 20% is an afternoon in crypto because it's highly volatile. It's a 70 vol asset versus a 15 vol asset. So it's much more volatile. So the idea is you need to be able to understand how to navigate the volatility. So what we call the banana zone, what is that? That's the accelerated point in the cycle where prices go exponential. It's usually at the latter point of the business cycle. And that's the kind of zone we started. We had the big leg up Q4 last year. We've had a corrective period, and then usually we now should go up for the rest of the year in a way that makes it quite hard to even buy, with a couple of sharp corrections en route just to gut check everything.
With the unknowns that'll come in through.
So now we've established that we're in this exponential trend that is driven by the business cycle. It's a 4-year cycle driven by the debt refi cycle. We're in the last year of that, which is usually one of the best parts of the entire cycle. It is going to be volatile throughout that period. So then my job is trying to communicate to people, okay, if you've been given the greatest performing asset of all time, then you don't want to screw it up. And it's hard because most people aren't used to volatility. It becomes emotion. And emotion doesn't help you in this. It'll force you to do the wrong things. So I try and explain to people, firstly, don't use leverage. It always looks great because you see some guy on Twitter who's made 100x returns and he's done it in perps and he's done it. It's like, it's never going to happen. You are going to lose your money. Because rule number one is don't lose control of your tokens. Because really, you want to hold it from here and you want to be Jeff Bezos here, right? And he didn't lose control of his equity. You don't lose control of your tokens. So that's really vital. It's also, don't FOMO, because you'll find out you'll end up buying at peaks and selling at troughs. That's the emotional side of things. Also expect 30 to 40% pullbacks often and think of them as normal. And if you've got cash, that's when you buy more stuff. So it's like having this mentality. It's also be careful not to lose your tokens because you get hacked. So store them on a ledger system somewhere. Keep a cold wallet. Just simple things like that will stop you losing your tokens, stop you, even you FOMOing in fear, selling out, panicking, or bull market buying too much. If you don't do that, you'll lose control of your tokens. Again, just don't lose your tokens.
The basics.
And just hold it from here. And in 5 years' time, it'll be here. And in 10 years' time, it'll be here. And people don't believe that's possible. But this is the gift that keeps on giving it. It's the same with NASDAQ.
Yeah.
Right? Tomorrow will be more digital than today. It's a simple fact. So will tech stocks over time do well? And everyone goes, yeah, but they crashed in 2000.
Right.
Okay, well, we had a massive bubble in tech stocks then. You pay back for a year or two, but anything you bought into that crash was Amazon, Google, Apple, all of these things did stunningly well. So people just have the fear of what's happened in the past, but we know this tech adoption curve is not going to stop. In fact, it's increasing. So the probability is, even if you have a bear market, which we had in 2022, it lasted 1 year, 9 months. 9 months, it bottomed out with liquidity, and it's been up ever since.
Yeah.
Raoul Pal highlights liquidity as the key driver of financial markets, including crypto, emphasizing the importance of assets that outpace inflation and currency debasement. He identifies Bitcoin and Ethereum as standout investments due to their strong performance and network effect. Focusing on exponential technologies like AI and crypto, Pal stresses the need for a long-term, emotion-free investment strategy. He and others, like Arthur Hayes, foresee significant Bitcoin growth driven by fixed supply, rising adoption, and expanding global liquidity.
I'm the wrong person to talk to about diversification. Because I've run large diversified portfolios, big hedge fund portfolios with many, many positions. And what I found is, since I kind of discovered that everything code thesis about liquidity being the dominant driver, I realized there's one macro driver that drives everything. And then on top of it is the adoption of technology, whether it's crypto or tech. Those are the two megatrends. Nothing else outperforms the debasement of currency, which is 8% a year plus 3% inflation. So 11% a year is what you need to do to break even on your savings. And so you've only got two assets to do it, technology and crypto. And when I divide the NASDAQ by Bitcoin, it's down 99.97% since 2012. On every time horizon, it's underperformed. But they're driven by the same factor. 97.5% of the price moves of the NASDAQ are explained by global liquidity and 90% of Bitcoin. Yet, the performance is so wildly different. So I don't even know any tech stocks. Yes, I have trade recommendations for people who do, etc. I don't know those. So now you've got the world of crypto. So then, if they're all being driven by the same thing, what you want to choose is the fastest horse. Now, that's not buying the meme coin that can go up 100x. What you're trying to do is look for what are meaningful projects being run by meaningful people with meaningful communities. So it's this Metcalfe's law idea, how many active users do they have? What kind of value are they creating?
The utility, if you will.
Yeah, it's the measurement of the entire utility of the network. Do people value the network? Do they want to build on it? Do they want to transact on it? Do they want to own it? And so there's not that many that really show this. You've seen some of the communities like Cardano has a huge lot of retail users, almost no applications. Bitcoin has both at scale. Ethereum has both at scale. Solana is earlier in the network adoption model, but it's got it at scale. Sui, arguably, very early, looks like it might get it. So then I played the dumb idiot. I kind of have a thesis in my head, and I'm just like, what does the chart look like?
Yeah, right.
And so you start with the chart of Bitcoin. That's your benchmark. Is the asset that you think is the greatest asset ever conceived, the one that you want to own, is it outperforming Bitcoin or not? 99% of all tokens don't. Okay, don't own them. But once you find the one that looks like it will, okay, now it's interesting. And that's what I had. That's why I switched from Bitcoin to Ethereum in the last cycle, then from Ethereum to Solana this cycle. Solana outperformed Bitcoin and outperformed Ethereum. And then halfway through the cycle, I realized the other horse in the race was going to be Sui, which was the ex-Facebook team built a blockchain, and I happened to be on the board of it, but it wasn't for that. It's because it was breaking out versus Solana, which was easily the strongest horse. I'm like, okay, this is the strongest horse squared. This is my bet.
Nice, interesting.
And so I'm pragmatic because, as you say, we don't know what will survive and what will do well. So I'm just pragmatically looking at kind of weekly chart time horizons.
Performance quite a bit. Yeah.
Is it breaking properly? You know, have I got something to capture in understanding how it's going to move going forwards? I'm not interested in day by day stuff. You know, is it structurally looking like it's going to outperform? If it is, I'm going to hyper concentrate because then I don't have to worry about anything else.
Yeah.
Raoul Pal highlights liquidity as a key driver of financial markets, with Bitcoin and Ethereum standing out as assets that outperform inflation and currency debasement. He also stresses the transformative potential of technologies like crypto and AI, urging investors to adopt a long-term, strategic approach. With predictions of Bitcoin benefiting from growing liquidity and its fixed supply, Pal and others see significant opportunities ahead. This reinforces the importance of staying forward-thinking amid rapid financial changes. How do you think Bitcoin and Ethereum will influence the global economy? What helps you stay focused on long-term goals during market volatility?